Let me ask you something honest. You made more money this year than you did 3 years ago, maybe 20% more, maybe 40% more. So why does your bank account look exactly the same? You're not blowing cash at the casino, you're not buying Ferraris, you're just living, paying for stuff, being a normal person. And yet, the number barely moves. Here's what nobody tells you. The habits draining you aren't dramatic. They don't feel like mistakes. They feel like common sense. You pay your bills, you don't do anything crazy, you tell yourself you're being responsible, and somehow you're still stuck. That's the entire problem. I'm going to show you 9 financial behaviors that feel completely logical and are quietly wrecking your future. Real examples, real math, and at the end, one framework that ties all of it together.
You get a $4,000 bonus. Before it even clears, you've mentally spent it. New laptop, nice dinner, maybe a weekend trip. You worked hard, you earned it. 6 weeks later, $3,200 of it is gone, and you can't quite account for where. This isn't a discipline problem, it's a windfall blind spot. Research from the National Bureau of Economic Research found that people spend roughly 90 cents of every unexpected dollar within 2 months of receiving it. 90 cents. The money arrives, feels abstract, and gets absorbed before you ever make a conscious decision about it. The fix isn't guilt, it's a rule you set before the money arrives. 50% of any windfall gets locked away before you touch the other half. Non-negotiable, automated, done. You still get to enjoy the bonus. You just stop letting all of it disappear into a blur of reasonable feeling purchases. Now pull out your credit card statement. Not mentally, actually pull it up. Count every recurring charge, the streaming service you share a password with anyway, the app you downloaded in January that auto-renewed in April, the cloud storage tier you bumped up to upload photos you've never looked at. The average American household pays for 4.5 streaming services and regularly uses 2 of them. That dead weight alone runs about $540 a year. Stack in the software subscriptions, the apps, the gym membership used twice a month. Most people are bleeding $120 to $160 monthly on services they'd cancel immediately if they saw them as one single line item instead of scattered $8 and $14 charges. Do a subscription audit once a quarter, 30 minutes. Cancel anything you haven't actively used in 30 days. This isn't sacrifice. You won't miss most of it. You'll forget it existed. Here's the one that sneaks up on everyone. It's just $3,200. I can handle it. That sentence is costing you more than you think. At a typical credit card rate of 24% APR, that $3,200 balance generates about $63 in interest every single month if you're only paying minimums. Over 18 months, you've paid $800 in pure interest, and you still owe close to $2,900. The debt didn't shrink, the bank got paid, you got nothing. People tolerate small debt because it doesn't feel urgent, but a $3,000 balance at 24% is a better investment return for your credit card company than almost anything else they could do with that money. You're funding their growth, not yours. The moment debt feels manageable is exactly when it becomes permanent. You spend 45 minutes comparing hotel prices to save $18 on a weekend trip, but you haven't looked at your car insurance in 3 years. You clipped a coupon for $2.50 off cereal, but your credit card is charging a $99 annual fee for a rewards program that paid out $41 last year. This is financial attention misallocation, burning mental energy on small decisions while the expensive ones run on autopilot in the background. The math is brutal. Saving $18 on a hotel once a year is $18. One phone call to renegotiate your internet bill saves an average of $348 annually. Refinancing a $25,000 car loan from 8.9% to 5.4% saves over $1,800 across the loan term. You don't need to track every dollar obsessively. You need to audit the big categories once a year. Insurance, subscriptions, loan rates, phone plan. That's where the real money hides. There's a version of you that wakes up at 6 a.m., journals, meditates, and crushes it. That person has a $220 weighted blanket, a $180 leather journal, a $90 pour-over coffee setup, and a $400 standing desk. You've bought most of it, you use almost none of it consistently. This is identity spending, purchasing the props before you've adopted the lifestyle. The brain experiences buying the running shoes as almost the same reward as actually running. It's not. One costs $140, the other builds a habit. Before any purchase aimed at a better version of yourself, ask one question. Have I done this thing for free, consistently, for 30 days? If you can't sustain it without the gear, you won't sustain it with it. The equipment doesn't create the habit justifies the equipment. Your friend group has a spending average, and whether you're conscious of it or not, you're calibrating to it constantly. If everyone around you books $280 Airbnbs for weekend trips, you book $280 Airbnbs. If the birthday dinner expectation is $75 per person, you pay $75. If the group chat is always about the next concert, the next trip, the next thing, the baseline of what feels normal keeps quietly rising. A 2023 Bankrate survey found that 36% of Americans overspend directly because of peer pressure. But here's the number that actually matters. 71% of those people put the spending on a credit card. You're not just spending money you have, you're borrowing against future income to maintain a social image right now, in real time, for people who probably aren't tracking your finances any more closely than you are. The people worth keeping in your life won't audit your spending, and the ones who would? That's information.
In 2021, the average U.S. worker received a 4.4% raise. Most of them spent it within 90 days, not on anything memorable, just things. A slight upgrade here, a small improvement there. The lifestyle silently absorbed the raise the same way a sponge absorbs water, completely and without drama. Here's a rule that actually works. Every time your income increases, split the raise in half. Half goes to lifestyle, guilt-free. Half goes directly to savings or investment, automated immediately so it never passes through your checking account. You'll adjust to the rest. You always do. You've done it every time before. If you'd gotten a $400 per month raise 2 years ago and invested $200 of it monthly in a total market index fund, you'd be sitting on roughly $5,800 today, with market appreciation factored in. Instead, most people have a slightly nicer apartment and a vague feeling the raise wasn't enough. Two people, both invest $300 a month. One starts at 27, one starts at 35. Both retire at 65. The person who started at 27, roughly $1.1 million, assuming 8% average annual returns. The person who started at 35, about $490,000. Same monthly contribution, 8 fewer years. Cost, over $600,000. You don't lose that money to a bad decision. You lose it to no decision, to waiting, to I'll get to it when I understand it better, to I'll start when the market calms down, to I'll start when I have more. You don't need to pick stocks. You don't need to time anything. Open a Roth IRA, pick a total market index fund, set up an automatic monthly transfer, and leave it completely alone. That is the entire strategy. There's no secret beyond that. The complexity is an illusion people use to justify delay, and the delay is the only mistake that actually matters, because you can recover from a bad investment, you cannot recover lost time. The average American pays $1,300 per year in unnecessary bank fees, high-interest charges, and completely preventable financial mistakes, according to a Policy Genius study. Over a 40-year working life, that's $52,000 in direct losses, before you account for what that money would have compounded into if invested instead. But most people won't spend 3 hours learning how a Roth IRA actually works. They won't spend $15 on a personal finance book. They'll leave 14 streaming services running in the background for months without watching them, but sitting down to understand how a credit score is calculated feels like homework they'll get to eventually. The return on financial education is the highest return available to anyone at any income level. Understanding how compound interest works, how to negotiate a salary, how tax-advantaged accounts reduce what you owe every April, that knowledge pays dividends for decades, and the cost of not learning it compounds just as quietly, just as reliably, just in the wrong direction.
Here's what ties all 9 of these together. None of them feel dangerous. That's the point. They feel like normal adult life.
They feel like what everyone does, which is exactly what makes them so effective at keeping you exactly where you are year after year. But here's what actually moves the needle. Not motivation, not a side hustle, not waiting for a bigger paycheck. 3 systems. That's it. The first one is automate the important stuff. The moment your paycheck lands, money moves automatically to savings and investment before you ever see it, before your brain has a chance to rationalize spending it on something that feels reasonable in the moment. This isn't discipline, it's architecture. Discipline fails, systems don't. The second one is audit the expensive defaults. Once a quarter, one sitting. Subscriptions, insurance rates, loan rates, phone plan. Cut the dead weight. Renegotiate the big ones. The 10 minutes you spend here will outperform hours of coupon hunting. The third one is set a social spending ceiling. Decide in advance what you'll spend on group activities per month, not per event, per month. When the budget's used, you say, not this time. No elaborate explanation, no guilt. The discomfort of that one sentence lasts about 30 seconds. The credit card balance you avoid lasts much longer. Most people spend their entire financial lives reacting to bills, to social pressure, to sales, to whatever emotion is loudest at checkout. The people who actually build wealth aren't smarter. They're not making dramatically more money. They replaced reactions with systems. Small ones, boring ones that run without requiring willpower every single day. Every year you don't make the change is a year the math works against you instead of for you. Not dramatically, quietly. Compounding in the wrong direction, the way rust works on something you forgot to protect. You've seen the patterns now. You know exactly where the leaks are. The only question left is whether you fix them this week or explain next year why you still haven't.